Good afternoon, ladies and gentlemen. I would like to start off by thanking TABF for extending this invitation to me to participate in FinTech Taipei's International Forum. It is indeed an honor and a pleasure to be here with you this afternoon. My name is Chek-Tchung, and I am the Executive Director in the Global Finance and Technology Network, GFTN for short. Now, GFTN is a company, as my colleague Kito-san mentioned in the morning. We are a company that is focused on engaging the public and private sector in anything related to fintech technology and looking at innovations and what are the new advances that will impact financial services. And it is very much a pleasure to be here in Taipei, in your wonderful city. Now, the financial world is undergoing a very profound transformation, and digital technology is reshaping the provision of financial services through three broad areas. One, an expansion in the type of digital financial services and products, as well as their distribution channels. Two, the arrival of new suppliers of these financial services, such as big techs, fintechs, and other third-party service providers. And three, the increasing use of digital innovations to manage and mitigate risks. This ongoing trend of digitalizing financial services will continue to provide benefits to the economy, leading to greater efficiency, more convenience, and enhanced financial inclusion. However, these technological advances can also create vulnerabilities and amplify risks to financial institutions, consumers, and even impact financial stability. And this afternoon, I will be covering a particular aspect of how technological advancements and innovations impact the financial industry. And I will focus on their implications on financial frauds and scams. I will also discuss the technological tools and policy levers that can be leveraged to combat illicit activities. Financial fraud has evolved and has undergone a dramatic transition from spam to sophistication. In the past, fraud was largely opportunistic, and scammers relied on mass phishing emails, too good to be true investment schemes, and fake inheritance claims to trick vulnerable customers. And few scams have achieved the notoriety of the Nigerian prince email. This type of scam usually begins with an unsolicited email from someone who claims to be a person of royalty, importance, or wealth. And the sender will claim to have access to millions of dollars, but needs the victim's help to access or transfer the funds in return for a share of money. And the victim is asked to provide personal information over email and to make an upfront bank payment to cover transfer fees, taxes, or other purported expenses. And once the victim takes the hook and makes the first payment, the scammer will continue to invent reasons for additional funds to be transferred, while the promised returns never materializes. Now, these emails were often poorly written, probably because Chek-GPT wasn't available then, and also easy to spot. And just for your information, Chek-GPT was not used in producing this speech here. But then again, I did wish that I used Chek-GPT to help me generate some slides, so you just got to listen to me. Now, in this modern technology age, we face a new breed of criminals and their methodologies. Financial crime nowadays are no longer isolated incidences. We read of criminal networks running large-scale scam centers that are increasingly operating like corporations. And these scam centers even have internal departments for finance, logistics, and even HR. And this shift towards industrialized criminalization is alarming, not just for its scale, but for its sophistication. And they pose systemic threats to public trust and confidence in the financial system. Fraudsters and scammers have also evolved in response to changes in customer behavior and are exploiting digitalization to continue their criminal activities by shifting their modus operandi. As technology advances rapidly, so too will online frauds and scams move at a greater scale and speed than previously encountered. Global connectivity will make it easier and faster for criminals to find new ways to reach potential victims. Various of scams also reflect the dynamic and evolving nature of social engineering exploitation. So, what are the recent technological advances that have been exploited in this new era of financial crime? I would like to mention three: faster payments, cryptocurrencies, artificial intelligence. Firstly, faster payments. Instant and real-time retail payments are becoming the baseline financial services in many countries and economies. The speed at which funds are available to the recipient, plus continuous 24/7 system availability and high transaction limits are often what makes faster payments attractive for legitimate banking transactions. However, increased adoption of faster payments has inadvertently led to an uptick in fraud in some of the markets that have deployed faster payments, because the very same features of instant payments also make it attractive to criminals. Since the recipient has immediate access to the funds and can move them to other accounts instantaneously, the window to react to fraud is very narrow. Even if a fraud is detected, the time to respond to stop the payment is also very, very short, well before any alarms can be raised. Moreover, fraudsters can also work round the clock and also at odd hours, and for this reason, victims may not be able to check their accounts and report fraudulent transactions to the authorities expediently. And also to exacerbate the issue, faster payments integrated with other social and e-commerce applications make it easier for fraudsters and scammers to carry out social engineering scams. Secondly, cryptocurrencies and digital assets. Much has been spoken about cryptocurrencies in the morning session. Now, we know that blockchain technologies have revolutionized the financial world, offering speed and decentralization. However, the same technology makes cryptocurrencies a double-edged sword, attractive as a tool for crime, resulting in an explosion of investment and crypto-related frauds, such as pump and dump schemes and fake token offerings. The exploitation of the dark side of crypto for frauds and scams and money laundering are well documented. There are sophisticated online fraud schemes, also commonly known as the pig slaughter scams or 杀猪盘, where scammers build trust with victims before stealing their money through fake investments in cryptocurrencies. And billions of dollars have already been lost in such deceptive schemes. The anonymity and decentralized nature of crypto systems also pose significant challenge for law enforcement agencies. The immediate and irreversible transactions and limited traceability make asset recovery virtually impossible. Thirdly, AI. The rise of sophisticated artificial intelligence tools such as Gen AI and LLMs has introduced new challenges in the fight against financial fraud. Criminals are increasingly leveraging the accessibility of AI to create more convincing and personalized frauds and scams. AI-powered language models can generate highly persuasive text that is tailored to the most susceptible targets based on their online social profiles and behavior. Sophisticated chatbots can also be used to further enhance the plausibility of scams identifying and specifically targeting demographics or groups. And as more data about potential victims are collected online, AI can be used to develop highly specialized scams designed to exploit the vulnerabilities of particular communities. Gen AI also has the capability to create high-quality replicas of identification documents that can be used by illicit actors to enhance the effectiveness of their social engineering when carrying out scams. Fraudulently generated identity documents, such as the national identity cards, driver's license, or even professional credentials, can be used to open new bank accounts or to take over existing ones. And AI is making it harder to discern fakes from real. Fake documents are so convincingly generated that they can be used to circumvent identity verification and authentication methods. Another manifestation of AI being exploited is deepfake. Deepfake technology are synthetic media created using AI to imitate real people or events. These span a number of multimedia modalities, and their AI algorithms have the capacity to alter or substitute faces to create convincing videos or audio messages from seemingly trusted sources. And these manipulated videos can make the deception more believable, and they can be misused as business records or disseminated as false news stories to further convince victims of a scam's legitimacy. Instances of impersonation, falsified documents, and fraudulent transactions facilitated by Gen AI and deepfakes are already causing financial losses and reputational damages to financial institutions worldwide. As AI becomes more mainstream, the transition from a simple email scam to deepfakes demonstrates how fraudsters are able to quickly adapt their techniques to exploit these new technologies and also changing social norms. And their ease of use also means that even the non-technically inclined criminals can also have ready access to these tools. So we see that the convergence of advanced technologies, human psychology, and global connectivity can create this environment where criminals find new ways to exploit them and to prey on the victim's lack of understanding of how such technologies work. Now that we have touched on the threats and the implication of advanced technologies in financial crime, how should policymakers and regulators respond? Given the increasing complexity and challenges associated with detecting and disrupting frauds and scams, there needs to be an emphasis for a whole of ecosystem response to address them. And this overarching approach requires a combination of upstream measures, such as anti-scam or malware applications or tools to filter and block scam messages, with downstream measures, such as fraud surveillance and detection capabilities. The overarching approach also requires a critical need to focus on fostering collaboration across multiple government agencies, law enforcement bodies, as well as private sector entities. After all, it takes a network to fight a network. Fortunately for us, while technology may be exploited by criminals, technology itself can also provide us with the arsenal to combat fraud and scams. To counter Gen AI and deepfake-driven frauds, organizations are deploying multi-factor biometric authentication, AI-powered real-time anomaly detection, and digital identities to create a multi-layered defense against threats. Organizations are also starting to deploy liveness detection techniques in biometric authentication solutions to counter deepfakes. For example, users can be prompted to perform specific actions or to respond to stimuli during customer verification processes to check proof of presence. Behavioral analytical tools can also be implemented to analyze how users interact online and to identify changes in user behavior that may indicate stress or coercion. Blockchain analytical tools can also help detect and trace fraudulent activities and transactions. Regulators use on-chain analytical tools to track illicit crypto wallet flows, flag suspicious token transfers, and also to support law enforcement investigations. RegTech solutions can also supplement such efforts by streamlining compliance through automated reporting, risk scoring, and identity verification. We know that technology alone cannot solve all these issues because frauds and scams are fundamentally an exploitation of trust and can be distilled down to human manipulation. While technology plays a critical role, it cannot teach judgment and caution. No firewall or amount of spam filter can prevent someone from clicking on a suspicious link despite seeing the warning signs. And this is where government bodies and law enforcement agencies come in. To truly combat fraud and scams, technological tools must be paired with robust and supportive policy responses to effectively combat financial crime. Policy measures should be implemented with key objectives to preserve confidence in digital financial services. Authorities should also recognize that the responsibility for preventing fraud and scams should not lie solely with the members of the public, but also with industry stakeholders. Hence, there is a need to strengthen relevant stakeholders' direct accountability to consumers on losses incurred from scams. Financial institutions and other stakeholders involved in financial services should be answerable to their respective regulators if they fail to implement the necessary anti-fraud and anti-scam measures. Equally crucial is an informed and vigilant public, which serves as the first line of defense in the collective fight against frauds and scams. There needs to be an emphasis on the individual responsibility to be vigilant and discerning. Each of us have a responsibility to practice proper cyber hygiene and not give away confidential banking credentials to a third party under any circumstance. Allow me to draw several references from Singapore's response towards combating and preventing financial scams. In December last year, the Monetary Authority of Singapore, Singapore Central Bank, implemented a shared responsibility framework, or SRF for short. The SRF is to apportion and share responsibilities for scam losses amongst financial institutions, telecommunication operators, and consumers for unauthorized transactions arising from scams. The SRF is part of the wider effort by the Singapore government and industry to protect consumers against scam losses. And the objectives are, firstly, to hold the ecosystem stakeholders accountable for implementing anti-scam measures to protect consumers. And secondly, to provide a reasonable avenue of recourse for scam victims. Specifically, under the SRF, financial institutions must implement real-time fraud surveillance to detect unauthorized transactions, block or hold suspicious transactions, and notify customers. Banks must implement 12-hour cooling-off periods for activating digital security tokens and provide real-time alerts for high-risk activities. Another requirement is that banks must detect large sums, defined as more than half of a balance of at least $50,000 that are rapidly drained from an account over a day. Such transactions have to be blocked until the bank is able to confirm the transaction with the customer, or the bank must send a notification to the customer and hold the transactions for at least 24 hours. And during this 24-hour cooling off period, customers who realize that they have been scammed can then cancel the transaction. If the transactions are legitimate, the funds will be released after the cooling period. Under the SRF, telecommunication companies, telcos, are also identified as important stakeholders, and they will be required to prevent spoofing and secure SMS channels to reduce scam exposure. The framework also expects customers to exercise vigilance, such as not clicking on suspicious links or sharing banking credentials. Now, if any party, whether the financial institution, telco, or customer, fails to meet their respective obligations, they will be held liable for part of or all of the financial losses under this framework. Specifically, financial institutions and telcos will provide payouts to scam victims for a defined set of phishing scams if their specific anti-scam responsibilities were breached. Aside from the implementation of this shared responsibility framework, Singapore has also passed a protection from scams bill in January this year. And this legislation allows law enforcement agencies to issue restriction orders to banks if there is reasonable belief that account holders are making transfers to scammers. Basically, this is to restrict self-effected transfers made by potential victims. And this temporary restriction will suspend money transfers for 30 days. And the intent is to buy law enforcement agents more time to engage and convince the victim that he or she is being scammed. The Singaporean authorities have also adopted other regulatory measures to safeguard online spaces. We know that a large proportion of scams occur through channels such as messaging apps and social media platforms. And there have been calls for such tech companies offering these services to share some form of responsibility. And specifically, the Singapore government implemented the Online Criminal Harms Act in July 2023. This legislation requires designated online services, such as social media companies, to put in place measures to proactively prevent and disrupt scams. Now, taken together, many may perceive that banks and government authorities are being overly intrusive and exercising unnecessary control over customer money. We need to strike the right balance between protecting an individual from further harm and not unduly inconveniencing him or her in legitimate banking transactions. Now, legally speaking, the money in the bank belongs to the customer. However, there is this tension and the risk of giving customers, particularly vulnerable ones, full control that they may not be aware of what are the precautions to take. There has been feedback that the measures implemented by the Singaporean government is highly intrusive and should only be used as a last resort if all other efforts to convince the individual have failed. And this is a matter that bears a lot more conversations. Anti-scam measures by banks and government have shown measurable success in protecting customers, but they continue to raise concerns about privacy, autonomy, and overreach. Honestly, the jury is still out there on whether these measures undertaken by authorities are effective in the long term. And I guess time will tell. Now, having described the technological tools and policy levers that can be used to combat and prevent financial fraud, we are also fully aware that the threat of financial crime will not be entirely eliminated by any single jurisdiction. And this is where I want to make a few comments on the importance of regulatory alignment and cooperation, which is another important lever to tackle financial crime. And later, there will be a panel session on international cooperation on financial fraud prevention. And we can discuss a bit more about that later. And we know that digital fraud by nature is cross-sectoral, and criminals operate in networks and do not respect borders. On the other hand, regulators typically operate within national boundaries. There is a need for better collaboration and alignment. Information sharing agreements, mutual recognition frameworks, and shared fraud registries are but some of the possible levers that authorities can deploy, to facilitate such a cross-border collaboration. And there is also value in advancing collaborative experimentation to demonstrate and test the feasibility of innovative technologies to combat financial crime, particularly for wider adoption, especially when implemented on a network or cross-border basis. And regulators are in a unique position to support and collaborate on such technology experimentation. And this experimentation provides an avenue for regulators to understand and become familiar with new technologies, and also to foster greater regulatory clarity and support for their adoption. Let me conclude. The landscape of financial fraud has undergone a seismic shift. What once began as crude email scams have evolved into a sophisticated web of deception powered by technology. And as responsible stakeholders in the financial ecosystem, we have to wield the tools of innovation, not just only to grow economies, but also to use technology to defend economies and the public. There is growing consensus that new regulatory rules and policy levers are needed to effectively combat international financial frauds and scams. But individual government effort alone will not be enough. There needs to be a whole of system, proactive and collaborative approach. Now, whether or not we are successful in combating financial crime is not just measured merely by arresting criminals, how many we have arrested or prosecuted. Neither is it measured by the recovery rates of lost funds, but it is measured by the restoration of public trust in digital finance. Thank you for listening, and I wish you a meaningful time and fruitful conversations for the remaining day.